Hi, Spencer here, and today I'm going to talk about one of the interesting patterns, the rectangle price pattern. Now, this is a pattern that we might have seen on the chart because intuitively you can spot a rectangle shape pattern on the chart, but we're not sure how exactly to go about trading it. Sometimes you see a very wide range rectangle, sometimes you see a very narrow range rectangle. So there are different strategies to trade each of these type of patterns. So today I'll be covering mainly how you can use these patterns to trade breakouts. So what exactly you'll learn, the underlying psychology behind the pattern, how it forms, why it forms, and why it's a versatile pattern for trading breakouts. So later on you will see there are a lot of different strategies, different ways that you can trade this pattern, how to differentiate between the narrow range and the wide range patterns. So as I mentioned, there are narrow range and there's wide range. So how exactly you differentiate? How wide is wide and how narrow is narrow? So I'll give you an idea of how to differentiate that and effective trading strategies that work for this pattern. So in total, I'll be covering 4 different trading strategies. And lastly, how you can increase your odds of success when you are trading this pattern by combining it with other principles or other tools. Okay, so as I mentioned in my previous videos, there are 2 main types of price patterns, the reversal patterns and the continuation patterns. So in the rectangle pattern traditionally, right, if you have read books, they classify under the continuation pattern. But this is not always entirely true, as later on you will see during the strategies. It really depends on the context of the pattern because the rectangle pattern can also serve as a reversal pattern. So you need to see very carefully the additional factors, right, in this pattern that will help you decide whether you want to trade it as a continuation or a reversal pattern. Okay, so this is basically how the pattern looks like, the narrow range pattern, right, and the wide range. So the main distinguishing factor or the main way to differentiate between the 2 types of pattern is to look at how long it takes the price to get from one end to the other end. So for example, in a narrow range, each move could encompass maybe just 5 to 10 bars, right? Whereas for the wider range, you will see several legs of movements, right? And this will definitely encompass like way more than 20 bars for each time it moves up and each time it moves down, right? So basically, between the upper bound and the lower bound, you will see a lot more than 20 bars, whereas for the narrow range, you will generally see between 10 to 20 bars between the upper and lower bound. So that's just a very simple way to distinguish between a narrow range and a wide range pattern. Okay, the reason why um, I've colored this green and this red is because uh, in the narrow range, if it breaks up, it tends to be bullish, and it breaks down, it tends to be bearish, right? Whereas for the wider range, it tends to have more forced breakouts, meaning when it breaks up, the chances of it coming back down is higher than it continuing upwards. And when it breaks down, the chance of it rebounding up is higher than it continuing downwards, meaning the chance of success for breakout is much less for a wide range. Hence, I color it both blue. Okay, now let's take a look at some of the real examples of the pattern. So this example of a narrow range rectangle pattern where you can see that there's an existing trend and then there's a consolidation and then the trend continues. So you can see that between the upper bound and lower bound, right, there are about maybe 10 to 20 bars and 10 to 20 bars here, right? So and when we go to the wide range patterns, you can see that it takes a lot more bars between the lower bound and the upper bound, and also between the upper bound and lower bound, right? When it comes down, it also takes a lot of bars to complete the pattern. So overall, you can see that it is a much wider pattern, and because it's much wider, there's a lot more choppy price action, so you will tend to see more like breakouts, and it's also much harder to define the range because there are, like it doesn't always end up at the exact same point, right? If you compare it to here, the range is more or less pretty uniform, whereas for here, you might get prices that come near the top but don't exactly touch the top, or you might get prices that come like near the bottom but don't exactly touch the bottom, right? So therefore it is going to be a lot trickier to trade the wide range type of pattern. Okay, so what is the psychology behind the two types of rectangle pattern, the narrow range and the wide range? So in the narrow range, the buyers and sellers are building up their positions for the next big move. So if you see a narrow range in the middle of a big trend, right, quite likely what is happening is that the buyers or sellers are sort of taking a pause, right? So maybe some of them are taking profit, or some of them are just accumulating to wait for the next big move where the trend continues, right? Whereas for the wide range, the buyers and sellers are not really sure of the direction. They're not sure whether the market is going up or down. So the traders just tend to trade between the range, right? Meaning they short near the top and they buy near the bottom. So they are basically trading within the wide range. Right, so you can see that the psychology here is very different between the two types of range. Hence, the strategy that you use will also be quite different. Okay, but overall, the main strategy is to position ourselves strategically and try to enter the market just as a big move is likely to happen. Okay, so very important, right? Remember, you want to enter just as a big move is about to happen. Okay, so here are the four trading strategies, and I'm going to go straight in. Okay, so the first one is two are for the narrow range, right? The first two is for narrow range, and number 3 and 4 is for the wide range. So for the narrow range, we have accumulation breakout and trend pullback and breakout. And for the wide range, we have buy low, sell high, and breakout plus pullback. Okay, so strategy 1, accumulation and breakout. So this strategy is actually more of a reversal, right? So remember earlier on I mentioned that the rectangle can be both a continuation and a reversal. So this example shows it in how the triangle can be a reversal pattern. So usually what this happens, and you'll see quite commonly, is that it will start off with a prior trend, right? So in this example, it is a prior downtrend, right? And quite commonly you see in stocks that that have crashed, right? So there might be a big crash, which is the prior downtrend, right? And then people sort of lose interest in the product, right? In the stock, and then you will see it followed by a long period of consolidation in a narrow range rectangle. So what's interesting is that if you look during this narrow range, you will see that prices initially, volume initially starts to decline when people lose interest, and within the range, the volume stays pretty narrow. But once it is nearing a potential breakout, you will see that the volume starts increasing. So that's actually a first like early alert, right, that you can notice on the chart. And when the breakout actually does happen, you will see a sharp spike in the volume. So that is actually the first opportunity which you can use to enter the breakout, right, which is going to be in the new direction. And if you miss the first breakout, there's a second opportunity, which is the pullback. Right, so the pullback is usually the first pullback that happens after the breakout, where prices go back to test the breakout. There's also a good entry opportunity, and you can see that after that the trend, it changes to an uptrend, right? So this whole thing is actually a reversal. Okay, so for this strategy, when you are entering, you will probably want to place your stop loss. If you're entering near the breakout point, right, you can place a stop loss somewhere slightly below that point of entry, right? Or if you are more conservative, you can place your stop loss in the middle of the range, right? So if this is the range, your stop loss will be somewhere in the middle over here. Okay, let me just draw it down. Okay, so if you're entering somewhere here, right, your stop loss, you can place it somewhere here, or more conservative, right, place it in the middle uh, of the triangle, the whole range, right? And if you enter here, actually is the you enter is the same, right? Stop loss somewhere over here, or you can use this stop loss as well. Okay, as for where to take profit, generally for rectangles, the way to measure or project the price is to take the range, right, of the rectangle and then project it, right? So you get a same, but in this narrow, because for narrow ranges you don't usually use this technique because the range is so narrow, so it doesn't really give you much meat on the trend. So a much better way is to use uh, other methods for getting your price target, for example using your support or resistance, or using a trailing stop loss. Okay, next we go on to strategy 2, where in this case the rectangle is part of a continuation pattern. So in this scenario, we have an existing uptrend and then we have a pause in the main trend. So this pause is what we call a pullback. Right? We see a pause over here, and then the prices break out of the rectangle and resume the uptrend. Okay, so kind of similar in terms of entry. You enter upon the breakout here, right? You place your stop loss, somewhere maybe below the range, sorry, below the breakout point, right? Or you can also use the middle of the range if you are more conservative. And then when prices pull back, you can also enter here, right, and use the same stop loss, and then you get to capture the new uptrend. So this is the second strategy, right? Entering on the pullback of the main trend using the rectangle pattern. Okay, you see this quite a lot actually, and in a strong trend, you can actually get many different rectangles. Sometimes it's a rectangle, sometimes it is other type of pattern, like maybe a small triangle or flag pattern. Okay, the third strategy, now we move on to the wide range rectangles. So for the wide range rectangles, it is not that simple to trade the breakouts because, as I mentioned earlier, there's a more uncertainty. So the breakouts have a higher chance of failing, right? Meaning you're going to have more false breakouts. So one of the strategies to trade the wide range rectangle is really to buy low and sell high, right? So a lot of people might have heard of this strategy, it's a common term that's been bandied around: buy low, sell high. But people don't realize that it actually tends to work best in a wide range, right? When the market is trending strongly, you want to buy high and sell higher, right? So this buy low sell high doesn't really work in a trending market, but it works very well in a ranging market, right? Such as this wide range rectangle. So in this example, you can short over here, right? So if you're shorting over here, right, you probably want to place your stop loss just above, slightly above the upper bound, right? And your target will obviously be somewhere near the other side, right, which is the lower bound. And when it reaches here, you probably want to look to go long, right, and place a stop loss, right? And so you can repeat the process for as many times as it hits the upper and lower bound, right? But do note that it doesn't always exactly hit, right? Sometimes it reaches here, sometimes it reaches here, right? So most likely what you'll want to do is sort of have a one simple method that I use is to just dissect the range, right, into 4 parts over here. So it depends on how wide the range is, right? So generally this part over here, right, which is the top 1/4, will be the area where I'm looking to sell, right? And the bottom 1/4, right, will be the area that I'm looking to buy, right? So this gives me a bit more room for error, right? Because the prices do not always, exactly touch the top or bottom of the range. Okay, so at some point of time, obviously the price will have to break out of the range, right? Whether it's going to break up or break down, right? So if you can see the last example over here, this if you enter over here, right, and you'll probably get your stop loss hit over here, right, which is where you want to get out of the market. Okay, which brings us to strategy 4, right? On the same chart, the breakout, right? How to trade the breakout on the wide range rectangles. So one of the main difference for trading breakouts between the narrow range and the wide range is that because the wide range has more forced breakouts, you want to wait for a pullback for the wide range. Right? So for the narrow range, you can immediately enter the breakout once it happens most of the time. Whereas for the wide range, you will always have to wait, or it's always best to wait for a pullback, because the waiting for the pullback allows you to escape any false breakouts that might happen. So in this example here, we see that previously when you entered here and you got stopped out, right? That is where the breakdown happens. So this is where the pullback is, where you can make your entry, right? So you probably want to enter your short position somewhere here, right, with a stop loss just above it, right? And then you can wait, right, to capture this move down over here. Right, so the way to get a target is to measure the wide range, the whole range here, right, and then just project this downwards, right, which should give you a potential price target. Okay, so this is how you can use the wide range to trade. Okay, so I've covered all the 4 different trading strategies, right, telling you where to put your entry, stop loss, as well as potential targets. Okay, so just to recap, right, there are 2 strategies for the narrow range, right, and 2 strategies for the wide range, right. So if you haven't, you still find a bit confusing, you might want to rewatch the videos. If you have any questions, you can post them in the comments below. And for the last part, I'm going to share with you some trading tips, right, additional trading tips that you can use to increase the odds of success for this pattern. Okay, so the first is to trade with the larger trend. So if you compare trying to trade a reversal versus trying to trade a continuation pattern, right? The continuation pattern definitely has a much higher percentage, because when you're trading with a trend, your odds of success are always higher. Okay, so if you want to trade a reversal, you will need more factors, right? For example, you need to maybe study the volume, or you need to see, how long the accumulation is, right, in the rectangle, to see whether, the accumulation is sufficient to reverse, right, the existing trend into a new trend direction. Okay, the second point, the wider the range, the greater the uncertainty and the bigger the risk, right? So for the wider range, right, there is, as I mentioned earlier, more uncertainty in the prices, so it makes it harder to trade, right? And therefore, the bigger the risk, because say for example, you are trying to buy low and sell high, your buffer for the stop loss, right, has to be wider, because you cannot always pinpoint it as the top and bottom of the range. So therefore, if you are trying to enter near the top and bottom of the range, you have to give a wider buffer for your stop loss. Okay, the next point, when in doubt, wait for pullback after the breakout. So sometimes if you're not so sure whether this breakout is going to be a genuine breakout, maybe the volume is low or the price action doesn't look that strong, right, then the easiest way or the safest way is simply to wait for a pullback, right, because it's better to miss the breakout than to enter a breakout and end up losing money, right. So it makes more sense for you to wait for a pullback, right, get a better entry, a lower risk entry. If the pullback is, if the breakout is not such a strong setup. Okay, and lastly, the longer the pattern takes to form, the bigger the potential move after the breakout. So if your rectangle takes takes a long period of time to form, right, that actually means that it's really going to be a good opportunity, right? And you want to keep track of it, because once the longer the longer the pattern takes to form, it means that the more time the buyers and sellers have to accumulate their positions, right? So if they spend so much time accumulating the positions, it just means that they're going for a much larger move, right, than just a small move. So that means that that's why I say that the potential move after the breakout is going to be much bigger. Okay, so that's all for the rectangle pattern, right? So I hope you have learned something useful. And if you would like to continue learning for more videos like this, right, please do subscribe to our channel for more new weekly videos, right? And that's all for today, and I'll see you in the next video.